My name's Fred SaintAmour, and I'm with Boathouse Commercial Funding Group. Today, we're going to cover the ins and outs of hard money lending, how to do it, and how to avoid any mistakes and pitfalls doing so.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 488. In today's market, many investors are finding it harder than ever to uncover strong, reliable returns. That's why more high net worth individuals are becoming the bank, earning double-digit yields by making short-term, real estate-backed, hard money loans. But there's a right way and a wrong way to do this. My guest today, Fred SaintAmour, has closed over 200 hard money loans through his company, Boathouse Commercial Funding Group, and he's built a system that balances risk and reward through conservative underwriting and solid borrower vetting. If you're curious how hard money lending works and how to do it correctly, this episode is for you. Fred, welcome back to the show.
Thanks, Brian. Glad to be here. Thanks for the invite.
Fred, let's talk about hard money. But before we get into it, just let our listeners know, what are we talking about when we talk about hard money loans?
Hard money loans, I'm not sure I love the term, but the term is derived from you're lending on the hard asset. And that's why it's called a hard money loan, where essentially you look at the value of the property and you lend based upon that. So maybe credit or income aren't really underwritten as stringently as it would be for like a high loan to value full doc loan.
Are you looking more, when you do a hard money loan, are you looking more at the asset that you're lending on, or are you looking at the borrower?
Well, we can kind of take a two-prong approach. We look at the asset we're lending on, and they're usually at reduced leverage of 50 to 65% loan to value. But we still look at the borrower and their circumstance in order to develop an exit plan. Like, it's one thing to give someone a loan, but we want to make sure that they can get out of it. And then, we take those factors into account, whether they need to bring up their credit score, or a lot of them are waiting on tax returns. The business owners waiting on tax returns. Some just need the money fast. So we lend on the hard asset, but we evaluate the whole picture so we know that the borrower can refinance us and pay us off.
Hard money loans are typically, 3 months to maybe 2-3 years at the most?
Yeah, 3 months to 24 months is pretty standard. And then oftentimes we build in built-in extensions just in case they need it.
But they're also more costly. And so talk about the difference between someone who would go get a traditional loan at a bank versus a hard money loan.
If you have time to get a bank loan and you have the financials to get a bank loan, and you have the credit to get a bank loan is great. Most of our hard money loans, they fall into, hey, I need the money now, or my accountant's working on my tax returns and the bank needs those in order to lend, or they've had a credit glitch and a late reporting, and they used to be a 780 score, and now they're a 640 score, and the banks won't do it. So bank loans are great. They serve their purpose if you fit in that perfectly square box of theirs.
What I'm seeing right now is it's very hard to find investments that pencil out. So a lot of high net worth people are saying, hey, I've got money that I want to deploy. Why don't I make a hard money loan and get a high, double digit interest rate? So can you compare, what are the rates you might pay for hard money versus what you would pay for a traditional bank loan right now? And as we record this, it's May 2025.
An SBA loan, for example, they're anywhere from 8.5 to 9.5 right now. So, those rates aren't, low. Everyone still remembers the 3% loans and whatnot. And so our interest rates range from 9, some of them are 14%. And that really just depends on the circumstance and the properties being used as collateral.
So let's talk about how to go about making hard money loans. Let's say you have a borrower who has something they want to purchase. They have some property that they want to collateralize, and they come to you for a hard money loan. Kind of talk us through that situation. What is involved in the first conversation you have with that borrower?
Well, we just try to get a keen understanding of what the borrower's situation is and what their goals are. Hard money loans are often, referred to as bridge loans. So it's where they are right now and where they want to be, and if this loan can help them bridge that gap. On say a multifamily hard money loan, the property might not be fully stabilized or it needs repairs. And so we provide that interim, that bridge financing to get them from their purchase to where the property qualifies for more of a institutional type loan, long-term fixed rate loan.
Give us some recent examples of hard money loans that you've done.
One was a gentleman, he was or is a computer salesman. He's living in California. His family's back here. He had 2 single-family home rentals owned free and clear, each one worth about $200,000. And he was buying a 4-unit for $200,000 and needed $70,000 in rehab funds. So we went ahead and leaned all 3 properties. We gave him the $270,000, so he didn't have to go through the whole draw process because he's a busy man and this is a side gig for his family. So we gave them the money. They rehabbed the 4-unit. And we're refinancing the properties that are now stabilized to pay us off. That was one, the guy didn't have the time, right?
He needed the money quickly, and the only way to get that was through a hard money type loan.
Yeah, 2 things. He needed the money quickly, and he also didn't want to deal with the draw process and creating a written detailed budget and, get approvals for everything. We just gave him the money to do the rehab. All in, to purchase the house and the funds to rehab the house all in the same transaction. Another example is there's a guy, he owns a cottage, which is a second home for him. He owned next door to that, he owned a short-term rental, and the house next door to that became available for sale. So he'd have 3 properties all adjacent to each other. He switched up his EFTs at his bank last November, and something got messed up, but he has some lates on his credit report, so he has a 614 score, which doesn't really qualify for most conventional type loans. So we're leaning all 3 properties and giving him the money to purchase the 3rd on a 6-month loan. And in 6 months, we should be able to get his credit back up where he can refinance 1 or 2 of the properties and pay us off.
Yeah, and you and I were looking at that opportunity this morning, and that's a 40% loan to value on that opportunity. So a very conservative underwriting on that. So let's go through step by step on what is involved in your process. And I believe it starts with the borrower review. Can you take us through that process?
So we talk to the borrower. We understand their situation. We understand their goals. We understand the collateral. And then we, put out a term sheet to the borrower, spelling out the cost and the fees and the process. We kind of tailor the length of the mortgage based upon their situation. Is it going to take them 12 months to get out of this loan, or 6 months, or just 3 months? And we set up a term sheet accordingly and go over it with them and have the borrower sign it. At that point, they pay for an inspection. That's something I highly recommend is you need to inspect the properties. Like, make sure it's there, make sure it's not an insurance case and the roof is burned. So you have to have eyes on the property. And we either do that ourselves or we'll hire an appraisal for like a quick interior, exterior inspection and values. So once that checks out, we're okay with the collateral. We have to order title and update the insurance policies and make sure they have the proper insurance, update it to our loss payee clause. And then really we can close it that quick. As soon as we get title back and it's clean, we get insurance back. We go and appropriate the funds from different investors. We say, hey, to our list of investors, hey, we got this deal. Anyone interested in it? And, usually they bite pretty quick. They commit the funds and we set the closing. And the funds are transferred to the title company. We close the loan. And then Boathouse maintains servicing on them. So we collect the payments and then make the payment out to the investors. If there's a challenge with the loan, missed payments, late payments, no payments, we take care of that, including, God forbid, if we have to foreclose on someone. And so we handle that whole process.
If anyone is going to make a hard money loan themselves, I want to make sure they kind of understand some of the things that you brought up. So let's go back to vetting the borrower and the property. You talked about title, pulling title, and then also insurance. So when you say you're going to pull the title, what do you do? I mean, who does that for you, and what are you looking for, and what do you actually get when you pull the title?
We want to make sure the title's clear for us to be in first lien position. So most of these loans, we're in first lien position. Sometimes we might go second lien position on a property, but that's more just as added security than anything else.
So Fred, when you say first lien position, second lien position, what does that really mean?
Brian, all it really means is if the loan goes bad, we're in, the first spot to, if you're in second lien, you're the second person to be paid out. So it's always good to be in first position. It's a more secure position.
Fred, what do you look for then when you pull title when it comes to first lien, second lien, history of the property? What are you actually paying attention to?
We pay attention to a couple of things, Brian. One is we get a 2-year look back on the deed history of the property, and that tells us, who's owned it. And we're kind of just looking for a whole bunch of different maybe deed transfers from this LLC to that one, to this investor, to another. And that's more of a fraud red flag. If there's a whole bunch of different transfers and each time it transfers, the transfer amount's more. So we look at that. But mainly we make sure that we remove any liens that they're either going to be paid off or removed, and any encumbrances that may cloud the title being clear and maybe impede us being in first lien position.
Basic question here, but I want to make sure our listeners understand. How do you pull title? Like, who pulls it for you? Do you go down to the county and get the records, or where do you find the title, and who's the best place or the person to pull that for you?
We use a title company. And for most of our we're in Michigan, most of our transactions, we use the same title company. They're familiar with hard money loans. They understand our process. They can close anywhere in the state of Michigan and other states that we need them to.
You also mentioned insurance and pulling insurance, updating it. What are you looking for when you look at insurance? Is this title insurance, property insurance? What exactly should we be paying attention to when it comes to insurance?
Both property insurance and liability insurance. So we require that the insurance at least covers the loan amount that we're lending on the property. And then we have a liability requirement too, just in case, slip and fall or someone trips on the sidewalk. And then we are listed as not only the mortgagee, but as an additional insured on the insurance policies.
So if anything happens, like the house burns down after you've put the hard money loan on it, being in first lien position and being named on the insurance policy adds extra protection.
Absolutely. And if you're doing a hard money kind of construction loan, the insurance requirements, you have to talk with your agent or whatever, but the insurance for a construction loan is different than, say, just a regular long-term rental.
That kind of leads into documentation. What kind of documentation do you want to make sure you have as you go through this process and make this loan?
We do a credit pull, we do a soft pull, we do a background check. We'll do either a BPO, which is a broker price opinion on the property, or a comparative market analysis or an appraisal. We do that. Did I already say background check?
Yeah, I think you mentioned that a couple of times, but yeah, definitely background check.
Definitely background check. And you're just looking for fraud. And we get the Normally, these loans are made to an LLC. If so, we get all the entity docs and make sure that the LLC is current in the state. We get what's called a certificate of good standing to make sure it's a viable LLC and it's current. And that's updated insurance, updated title insurance. And then, of course, the big one, probably one of the biggest challenges someone new into doing hard money loans will have is the actual mortgage document. And there's, document services, for private lenders and whatnot. I've used several. Some are good in some situations, some are good in others. And that's just a learning curve that you're going to have to go through. But you need someone to create the mortgage docs. And it's not the mortgage docs we use, they're created by private lender attorneys, where maybe a standard mortgage document, like a Fannie Freddie type mortgage document, wouldn't satisfy the investor's needs to make sure legally the property is buttoned up as well as it could be.
When you say satisfy the investor's needs, who are the investors you're referring to?
Someone getting into hard money lending. If they're going to invest and do their own hard money loans, they're going to need mortgage documents. And so you have to get set up with a mortgage document company.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. I've made loans before and just kind of wrote up a note saying, hey, so-and-so owes me this much. But that's not a full doc mortgage. That's just kind of a note. But what you're talking about is like what the banks would expect to have, which is like full documentation mortgages written by attorneys and basically standardized for every loan that they do. What I'm hearing you say is that you have third-party software that basically creates those mortgages for you. Is that the case?
Yes. Again, these help reduce your risk. So if it's a rental property we're lending on and, the borrower stops paying, built into that document is an assignment of rents. So if they stop paying, we have the right to go in and have the rents come directly to us. So there's just layers of, these private lending attorneys, they've seen every situation and scenario, and they build their documents to protect investors in the case of default.
If you're making hard money loans, you want to make sure you have the proper documentation, have it written up as proper mortgage. Then what do you do? Record it at the county? I mean, how do you record that and make sure that it's legitimate?
Yep. We will also close the loan or have the title company who we ordered title insurance through close the loan. And then they take that mortgage or the note and record it at the county. And then they ship it back to us. So we have, proof that our lien position is secure in the county records.
Let's talk about servicing, because once you've made this loan, you then have to make sure, hey, the borrower is paying on the loan, and that not only are they paying, but there's a record of that payment being kept for future purposes, because at some point it might come into dispute. The borrower might say, hey, I paid this much, but you only have me down for this much. So you also do your own servicing. Talk about that.
Servicing is a big component because there's two things we need to do. We need to, take in the borrower's payments and then make payments to the different investors on the loans, and then kind of keep track of all those payments when it comes to tax time and whatnot, and give the investors feedback on their return on investment on the loan or the loans that they have with us. So it's detailed. If you're, one guy doing, one loan or two loans, maybe you can do it with a spreadsheet and you're using your own funds. But with us, we went out and bought software to help automate all that and to keep track of it and make sure, we're being compliant.
Part of servicing then, Fred, is that you make sure the borrower is paying. What happens if the borrower doesn't pay?
Yeah, and it may happen. We're always communicating with the borrower and getting an update on their situations. These are people who their payment may have bounced or whatever. So as long as borrowers are communicating, we work with them. There's a bunch of loan-to-own companies out there where they loan hoping you fail so they can take the property and make a profit. That's not us. So we'll work with borrowers, but sometimes life happens and we have to start foreclosure proceedings and whatnot. These loans are a little bit different, though. These are business purpose loans. These are commercial loans made on, residential properties, or commercial loans on commercial properties, where you don't have the consumer protections you might have if you're foreclosing on a primary residence, where there's a 6-month redemption and all these rights and privileges. And that might take a year. With business purpose loans and commercial loans, that process can happen a lot quicker. There's not the consumer rights.
How long would it take to go through foreclosure if a borrower were to stop paying?
3 to 6 months. In most cases, we try and work with them, work it out, have them sell the property. But if not, it's probably 6 months versus 6 months for a commercial loan versus 12 months plus on a consumer loan on a primary residence.
And then as a servicer, are you the one handling that foreclosure process, making sure that it's done correctly?
Yep. We take on that responsibility and, we foreclose, the property's sold, and then the investors are made whole.
And how many times have you actually had to go through that process?
We had to go through it twice, and both times investors were made whole. They got the interest earned and their money back. And then part of that is why we keep the leverage so low, the loan to value so low. So there's plenty of equity there to recapture our loan, our default interest, and any funds due to investors.
So Fred, how would people get a hold of you if they're interested in borrowing money or using your brokerage services?
The easiest way is shoot me an email. You can email me and it comes right to me. FRED at Boathouse. It's like it's spelled boat and then house. And then there's a CFG. BoatHouseCFG.com. Or if you prefer, you can call or text 269-838-3838, 269-838-3838. Either way, you'll get a hold of me.
I'll make sure that's in the show notes. And Fred, you and I, at full disclosure here, you and I have been doing hard money loans together, because not only do you make hard money loans, but you also raise money from high net worth investors to deploy those funds to be loaned and get double-digit returns. I'll say this to our audience: if you are an accredited investor, and this is for accredited investors only, and you are interested in making hard money loans, you can certainly follow all the steps that Fred just laid out for you and do it yourself. Or if you want to do it with Fred and myself, because Fred and I are working on this together, you can contact me. And I would say you could either email me at Brian, BRIAN, at higinvestor.com, or go to my website, which is higinvestor, INVESTOR.com, where I have information and you can kind of see some of the different loan opportunities that we have available. Again, this is for accredited investors only. And Fred, we've been doing this for almost the past year, just making some hard money loans together. And so far, they're all paying and doing pretty well.
Yeah, they're doing great.
Let me just wrap up with always my last question, which is, what's your favorite hack or app?
My favorite and least favorite is App Blocker. And what that does is during business hours, it blocks all the apps that I could get sucked into and lose 20 minutes of productivity like YouTube or X or, whatever it is. So I use that and I set up, and it really helps keep me focused and doesn't let me wander. That's my favorite app and least favorite because it forces me to be disciplined.
Fred, thanks for coming on the show today to talk about hard money loans. Hopefully our audience now has a good idea of what to do if you want to make a hard money loan. And you can also certainly contact myself or Fred and do it with us if you're an accredited investor. So thank you so much for being on the show today, Fred. It was a real pleasure talking with you.
Thanks, Brian. Appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.